Hello and a warm welcome to this quarterly update from SKAGEN Global. Portfolio manager Søren Christensen has joined me in the studio. First, Søren, what does the current turmoil in Russia mean for your investment in SKAGEN Global?
Yeah, I think if you look at sort of the fundamental earnings impact, if the situation stays the way it is now, I mean the earnings impact is minimal. So where you've seen an impact is obviously on risk premiums. So given what has happened, risk premiums on Russian assets has increased. So of course that has had a big impact on the price of Russian assets. And then you can say as a foreign investor, whether you invest in as a base currency in US dollars or euros or pounds, of course with a weaker ruble, that will also affect your the value of your investments in Russia. Mm-hmm. So that's where we've seen an effect. And then say, if the situation were to escalate, then there's of course a risk that you would start to see a real impact on earnings. So if you want to talk about individual names, an obvious candidate would be Gazprom, right? So of course they ship a lot of their gas through Ukraine. So you could of course paint a scenario where Ukraine might use that as a measure shutting off of the flow of that gas. And if that were to happen, then you would start to see a real impact on earnings in Gazprom. And that's of course why risk premiums has increased in Russia, right? Because the market is pricing in a likelihood that something like that could happen. And then you could say for the other Russian holdings, so far the sanctions on Russia has been very minimal, right? They haven't really had any impact. But of course, if the Western countries were to take it a step further and really start to impose measures that truly hurts the real economy in Russia, then obviously Sberbank, being a bank, will of course see an impact in terms of impact on loan demand and also on credit quality. But I mean, so far you clearly haven't seen that. You've seen a slowdown in Russian economy, but that's something that started way before the crisis in Ukraine and has very little to do with that.
Mm-hmm. But with the hike in premium or risk premium, that means that Russian companies are actually quite cheap at the moment.
Yeah, of course. I mean, with higher risk premiums, asset prices go down. So whether you say that they become cheaper, I mean, they have, of course, on paper, but whether risk has clearly also increased. So whether the risk reward has improved, that's sort of a different question.
Mm-hmm. How does geopolitical analysis influence the investment process in SKAGEN Global?
Yeah, I'd say it sort of comes in two ways. So firstly, on a company-specific level, obviously when we make a new investment, we want to make sure that we get paid to take that risk, right? So if we invest in a company that is exposed to potential geopolitical risk, we want to make sure that is reflected in the valuation. So that is sort of one way we try to control that and try to incorporate it in our analysis. The other way we try to incorporate it is how we construct our overall portfolio. So basically through diversification, right? So we want to make sure that we don't have too extensive part of our overall fund invested in companies that are exposed to the same type of risk. So for instance, it doesn't matter how cheap Russia becomes, it will never be 20-30% of the global fund.
Okay, so let's have a look at how SKAGEN Global performed during the first quarter.
Yeah, take the first slide here. As you can see, basically flat, completely flat in euros. The global stock market was up around 1%, so a slight underperformance. And I think we have some more slides going into more details in terms of what was driving that. But again, here the overriding theme was clearly weakness in emerging markets, where we have a fairly large exposure, and then particularly Russia, as we spoke about, which clearly got hurt, and our Russian equities, our Russian holdings clearly got hurt in the process. And that's also what you see here on the next slide, actually. So the markets in the first quarter, right? As I said, global index was up 1%, emerging markets was down 1%. And then you see on the bottom slide here, bottom of the slide, Russia by far the weakest market in the first quarter. But I think another thing that is very important to highlight in this slide is if you look at the top of the slide, you have two of the weakest markets last year, India and Indonesia. And I think that's very important to highlight because they became extremely unpopular last year. Everyone agreed that everything was wrong here. And really, the only thing that has changed so far this year is that you've had opinion polls showing greater likelihood of more reform-friendly politician coming into power. So, I mean, fundamentally, you haven't, of course, seen an impact yet, but it's made a huge impact on sentiment. And I think that that's important to note here that when you have dealing with markets that are so unpopular, small changes in perception can have huge impact on asset prices. And I think that's something that's important to note, particularly given the situation you're seeing in emerging market as a whole at the moment. And I mean, you've seen, for instance, after 21 weeks of consistent outflow, the last week of the quarter, you saw net basically zero, so outflow matched inflow. And then in the beginning of the second quarter, you've started to see net inflow into emerging markets, and that have already had a big impact on the relative performance of emerging market equities, and of course also had a big impact on the relative performance in the SKAGEN Global Fund.
But it might be a bit too soon to conclude that sort of emerging markets are on the rise.
No, clearly that it's too early to conclude. So my main point is just here pointing to what happened in India and Indonesia. I mean, prices are very low, and then small changes in perception can have a very big impact.
And it's also interesting because both Indonesia and India have upcoming elections.
Yeah.
How does that, do you think, impact the development in these two countries?
Yeah, but I think that's really been sort of the as I said, big trigger for this rally in those countries, right? Where I would say both these countries are struggling with lack of infrastructure investments. So, as I said, the polls showing that you have more reform-friendly politicians coming into power would, of course, go a long way of resolving those issues.
All right, let's have a look at the main contributors in the quarter.
Yeah, I mean, on the left side here you have the winners, and on the right side the losers in the quarter. So if we start with the winners, biggest contributor to absolute performance was Teva Pharmaceutical, global manufacturer of generic drugs. The main reason it did so well in the quarter is the fact that the biggest product goes off patent this summer, but they've successfully launched a new version of that product. So instead of having to take the medicine every day, you just need to take it 3 times a week. And they've been fairly successful in transferring clients or customers to the new product. And of course, when they do that, the profit pool will be less impacted by the generic producers coming in, competing with the old product. So that's had a big positive effect. Second one worth highlighting is Renault, so global auto manufacturer listed in France. Here it has really been the same story as we saw last year. So despite obviously very tough labor unions in France, the company has actually done a tremendous job in controlling cost. They've done a tremendous job in improving cash flow. So you've seen increased margins, increased cash flow, despite the fact that clearly auto sales, particularly in Europe, is still fairly sluggish. So that has had a very positive impact on the company.
And on the losing side?
Yeah, I mean, perhaps not unsurprisingly, on the top here you have a company exposed to both Russia and Ukraine. So VimpelCom is a global telecom company. It has around 40% of their business in Russia, around 10% of their business in Ukraine. So as we spoke about, higher risk premiums in those countries obviously hurt asset valuations of assets in those countries. But to be fair, I mean, the latest quarter in VimpelCom wasn't great. They lost market share in Russia. So the company feels that they need to invest more to improve their product. That means more pressure on cash flow in the short term, and that meant the company decreased the dividends quite substantially.
All right. And Citigroup as well?
Yeah. I mean, we had the annual stress test from Fed, and Citi passed that without any problems. So basically the Fed is saying that even under a very stressful macroeconomic scenario like we had during the financial crisis, Citigroup actually have enough capital. They don't need to raise capital, even in a situation like that. But despite that, they weren't approved for the share buyback program. And so it was not because it was too aggressive, the share buyback program. It was just that the Fed said the Citigroup's processes for forecasting losses under stressful scenario wasn't good enough. Right. So I think it's important to note here that that of course postponed our investment thesis for Citigroup starting to really return cash to shareholders. But the main stumbling block here is not lack of capital. It is the process. And that's something that should be fairly easy to fix. So I would say investment thesis is still intact, but it's clearly been postponed for 1 year.
Okay. Moving on, changes.
Yeah, we take sort of the new holdings on the left side here. We have Raiffeisen. It's a bank, large exposure to Eastern Europe. We feel that they have huge scope to reduce costs. So the cost-income ratio really sticks out compared to their peers. So clearly there's a lot they can do there. Historically, we've been a bit hesitant to invest because a very weak balance sheet. But that has been fixed. They raised equity, and then we think that has sort of fixed sort of the potential downside risk in the investment thesis. So that's why we entered. And you have Sanofi, a global manufacturer of pharmaceuticals, has had a lot of headwind the last year. So valuation has come down, and we still think that the market is underestimating the long-term potential, both for earnings growth, but particularly for cash flow generation and the company's ability to return that cash to shareholders. Mm-hmm. And then lastly, we have DSM, and I have a slide on that later, so I'm not going to spend too much time.
All right, we'll talk about that later.
Yeah.
All right, so you've reduced in a few companies as well.
Yeah, maybe worth highlighting Taiko International. It's a company that's been in the portfolio for a very long time. It's been a very long position for a very long time, and it's done extremely well. Operationally, the share price has done extremely well. So it's simply just the fact that we feel the market is increasingly agreeing with our investment thesis. That means that valuations have come up, and for that reason we see less upside, and that's why we decided to reduce.
Mm-hmm. Right, largest holdings, Samsung Electronics.
Yeah,
not surprisingly on top.
No, it's been there for some time now. No, but I think that clearly the share price moved up again last year, but it's just important to note that actually earnings improved far more than the share price. So actually valuation in Samsung has come down. So we still see a lot of upside potential in Samsung. I think the big trigger in the short term here is going to be that Samsung is really now entering a period where it really starts to harvest the cash flow of all the investments that they've done historically. For that reason, their cash balance is ballooning, and we think that the market is going to be surprised to see how they're going to spend that cash. We think that they will increase dividends significantly, and we don't think that it's unlikely that they would actually also start to buy back shares. But otherwise, for the rest, I mean, of course, all companies we feel very strongly about feel has very attractive risk rewards. And if you look at sort of the top 35, as we have on the bottom of the slide here, I mean, very low absolute valuation, despite the fact that the companies are growing. So that gives us confidence in saying that we expect a strong absolute return going forward. And I would say particularly with the weakness you've had in the emerging market over the last year, that has driven a large discrepancy in the valuation between our fund and the overall market. So I think we feel increasingly confident that we will also be able to deliver a very strong absolute return in the years to come.
Mm-hmm. But let's, on that note, let's talk a bit about developed market. There has been sort of a bull market lately.
Yeah.
How do you see that going forward?
Yeah, well, not just lately, basically over the past 5 years, right? You've had a tremendous bull run in particular developed markets. I think, first of all, it's important to note sort of where we come from, right? So coming out of financial crisis, equities were extremely attractively priced, right? There were a lot of bad things priced into the prices. So of course, with sort of the global economy sort of somewhat normalizing, sort of the tail risk diminishing, of course, you should see a big impact on asset prices, and you've seen that. If you look at valuations now, no doubt they've come up. I would say if you look at US equities, for instance, they are starting to look fairly expensive. And within US equities, there are pockets like some of the new technology companies, like cloud-based companies that, I mean, they have valuations that you haven't seen since the IT bubble, right? And you have some of the stable growing companies also having very high valuation and leaving basically no margin of error. But still, we feel pockets of the US market is still attractive. An obvious example is financials that are still trading at very attractive valuations. Another example is some of the old tech companies like Microsoft, like Oracle, that are no longer growing as fast as they used to do. But valuation is now very different, and because of lower growth, they're actually generating a lot of cash flow, and they're increasingly using that cash flow to return to shareholders. So I would say US equities look pretty expensive, but still pockets of opportunities. If you look to Europe, if you look at overall valuation of Europe, for instance, on a PE measure, it looks like it's trading in line with US equities. But I think it's very important to note that European companies as a whole, they've been a lot slower to cut costs than their US peers. So there's still a lot of room for European companies to cut costs. So that, of course, will help earnings. Secondly is that even though growth hasn't been fantastic in the US companies have been helped by improved activity. And of course, because of operating leverage, that helps the bottom line. So again here, we haven't seen that yet in Europe, so any signs that activity in Europe picks up and you start to see that on the top line of these companies, it can have a very big impact on the bottom line. So I would say European companies I still think looks fairly attractive despite sort of on paper a higher valuation.
Mm-hmm. All right, let's have a look at the company case, a new company to your portfolio. I'm not even going to try to pronounce that, but it's obviously a Dutch company.
Yeah, it is, yeah. So I'll just take the short version, DSM. So it's a chemical company, or at least it used to be. So it has its roots in sort of bulk commodity chemicals. But some 10 years ago, I think the company realized that they are not the companies with the lowest cost. In fact, they were nowhere near that. I think they realized that with all the new capacity coming on stream from the Middle East, of course that comes in with a very different cost structure because of low gas prices, they were going to be out of business. So they exited those businesses, and then they spent the past 10 years building a nutrition business, both organically and inorganically. So nutrition basically means, for instance, producing artificial vitamins that you add to food products. The company has increasingly gone downstream. So type of consultancy for food companies like Nestlé in terms of how you best combine the nutritions that the clients want into their food products. And I think that's really the big thesis here. That is that it is still lumped together with all the other chemical companies, but the fact that it's no longer a chemical company, it's a life science company. 2/3 of their business is now nutrition. And the key difference here is that, first of all, nutrition is going to grow a lot faster, supported by a number of sort of long-term structural growth factors. We think the market is going to realize that over the next 3 years. The true earnings power of the nutrition business has been held back by a number of one-off events, but we think the market has to realize that sort of long-term earnings growth is much higher than it used to be in DSM. And I think secondly is that the characteristics of the nutrition business is very different from the bulk chemical business. So it has much higher margins. It is less capital intensive, meaning that you can grow your business without having to spend a lot of capital. So basically the new DSM is going to grow faster, but it's going to be able to generate more cash flow than it has historically. And so when the market realizes that, it will also have to change the way it values DSM. Mm-hmm. So it's a company we feel very strongly about.
Very interesting. Thank you so much, Søren. Now, before we say goodbye, I'd just like to remind you that our brand new market report is, well, it's almost finalized, and just keep checking our website for an electronic version. All right, thank you so much for watching.